One indicator has everybody on edge. We can all see the deterioration in the New York Stock Exchange, and we can see some of these divergences that are leading to some of these massive omens that are being a problem for us. The question is, how strong are these signals? Have they confirmed? Who will be the winners and losers? We're going to cover a lot today on this topic. Why bears waiting for this pullback might have to wait a little bit longer based upon some of the movements we're seeing out there and some of these secondary names that are trying to be acquired. What does Meta's abominable quarter really tell us about OpenAI? Is this something that's actually going to run out of steam? Are we seeing the wheat from the chase? Are we really seeing a spot here where that's the end of this? Or are we just going to find out who the real winners are? We're going to dive into this and we're going to overlay it with some of the signals that we're seeing in the market right now and tie it all together so that it becomes actionable. With Amazon and Google doing their own thing, you really have standouts right here. And that's what we're looking for. We're looking for the standouts and then to see how sustainable that actually is. We keep hearing about the N, yet we're watching names like Western Digital and Seagate, and we're watching them hit all-time highs. 27.5% of you do not subscribe to this channel. Please click subscribe, all notifications. These videos are timely, and they are all linked together, starting with Saturday. Let's go. Now, this is the new thing that's supposed to terrify us, the Hindenburg Omen. And I think this is important to note. I think whenever you're looking at an indicator, instead of listening to somebody tell you, ooh, we have to be super scared of this, understand what it is. Understand what it's told us in the past. Understand when it negates. Understand when it triggers. Understand what it confirms. There's a huge difference between a trigger and a confirmation that you have a move. This is telling you that something happened. Whether or not that something is something we actually have to care about, there's a huge difference with this. And I think the easiest way to do this is for us to walk through what exactly this is and why it fires when it fires, and then work backwards and then see how we can profit from it. Remember, the biggest thing about all of these indicators and everything that we try to do on this channel and everything you should be doing as a trader is trying to get your craft down and your skill set down better than before, right? That's what we're really doing here. We're not saying this is going to happen because this is indicating. What we're trying to do is develop the craft, develop the skill set, get the information and education to make better and better decisions every single day. That's what we do here. Now, this is not my graph. This is Sediment Trader. I have no affiliation with them, but I just want to point out I do subscribe to it. And again, no affiliation, but I always want to show when someone else's work is being presented. And I think they do a good job of this, and I want to go through a couple other slides of theirs here, just breaking it down year over year so you can see what's happened over decades when this is fired and when it's worked and when it hasn't. Now, there's criteria for this, and there's criteria for a signal, and there's criteria for a trigger. So you may have something and say, ooh, and let's just talk about the difference of that for a second. So if I have a chart like this, and let's just say I'm looking to buy a stock. Let's say the chart's like this, right? And then all of a sudden it does something like this, boop, and I might go, oh, I'm breaking out of a base, and there's my signal that I'm supposed to buy. And then we don't wait for it to close, and then all of a sudden that signal fires, and then it comes all the way back down here. Well, I got a signal, but it didn't confirm, right? So let's say it came out again and then it broke out. I'm trying not to laugh because this is an awful drawing. And then I confirm by going up higher. Oh, that's a confirmation move. So there's a difference between a signal on a chart and a confirmation. And I think that's really important to get. And you're just going to have to deal with my childlike drawing as we go forward. There's 4 criteria for a signal. All right. Daily number of new 52-week highs and 52-week lows in a stock market exceed the threshold amount. Now, this is the very first thing I'm just going to point out to you guys. 52-week highs, 52-week lows. We definitely have to go over this. There's definitely data here that is very important to you that you're going to have to look at before Monday. There's no doubt about it. Because not only do I look at what these things fire, I tear into them. And then I'll take them apart. And I find great value in doing that. And it's worked for me for decades. So I continue to do it. And I'll give you examples of that in a moment here. But index exceeds threshold amount, typically set at 2.2%. All right, there's your first red flag, not yellow, red. All right, so in other words, one of the 4 signals I could trigger earlier or later by changing what the 52-week high, 52-week lows on those daily numbers are typically set at. That's the very first thing you should take away from this. And that's not a yellow flag. That's a red flag. That means some people could say it's triggering sooner. Some people could say it's triggering later. Really important. 52-week highs can't be more than twice the 52-week lows for this to trigger. That makes sense. Can't have more highs than lows. You can't have the strong breath of a market and then be out there and saying, hey, wow, we're really going to crash. All right, thanks, Rocky. The stock market index is still in an uptrend We are. The 10-week moving average or the 50-day rate of change is used for this. This gets really interesting. But when we look at the market right now, we would say we don't even need to know. The 10-week moving average is up. We all know this. We know that the 50-day rate of change, and you might not use that, is up. Signal, McClellan measure of shift in market is negative. All right, so define negative. Is that breaking the zero line? Is that rolling over and making a lower low? There's a little bit of language here that we have to be really careful about. Now, once these conditions are met, it's active for 30 trading days. Any additional signals during that period should be ignored, meaning it fired again. It fired again. They're saying ignore that. That's the one thing I really don't agree with here, because what I found value in this indicator is that when it fires more and more in a collective group, it's telling you that you have a rebalancing going on. So if I'm constantly hitting more new lows and constantly hitting more new highs, and I'm constantly rolling over and breaking the MACD negative, and my sense of the MACD negative could be a lower low, and the way that I would view that is a little subjective. I would view it actually as a negative divergence more than anything else. But the negative breaking the zero line may be what they're referring to, because that's pretty much the standard. But this gets interesting. Using the indicator, find it relevant for 30 days. It would take short, exit, long positions. Those paying attention indicator might have escaped the 87 market crash and the 08 financial crisis. I'm going to go through those periods of time and show you a much easier way to have seen this. 3 things have to trigger. In other words, we have the signal, and then you have the confirmation. New York Composite Index must be higher than 50 days ago. Actually, we are right now. Many stocks must make new 52-week highs and lows on the same day. Many stocks must make new 52-week highs and new 52-week lows on the same day, indicating a market indecision. Well, that's interesting, because then you're also saying that you have to be skewed, but I understand why they're saying that, because that would lead to massive rotation. So like if you're out there and all of a sudden all the XLP names that are discretion, right, that you would buy, meaning you want Clorox and Colgate because they're needs versus wanting the jeans from, American Eagle. That kind of makes a little sense, doesn't it? You really wouldn't be buying tech if you think there's a market going to crash. You'd be buying toothpaste. McClellan oscillator must be negative, indicating a shift from positive to negative breadth. Okay, and that's going to take us back to here. So now we know why this fired when it fired. And let's just look at a couple examples before we go any further. So if we take a look right here, what are we saying? Well, we're seeing that we fired, so we should pay attention to it. All right, well, we fired here in May of 24, or right around, it looks like it was around that June, July area. And how'd that go? Well, that kind of marked the top, and then we kind of rolled back over a little bit. Okay, and then it fired again in September, around September 19th. How'd that go? We ripped for about a year. Okay, so we kind of went higher there, didn't we? So we would say that really wasn't helpful, where we could say that the one previous could have been helpful in avoiding coming back down here a little bit. And that's not really the biggest drop in the world, by the way, guys. But I do think it's important to take a step back and say, okay, well, let's take a look at that and see, does it really matter? Well, this is the first indicator that we had. And right into that indicator, we would have missed a move. Now, maybe you don't care about this move because you're looking longer term. But when that indicator fired off and then the market goes up 4%, are you going to care? You're probably going to care, think you're wrong, and then step right in front of a train. All right, so what is this telling us? It's telling us that maybe if this thing fires, we trade and maybe we keep one foot out the door, but we don't view it as the be-all, end-all. We look at other indicators while we're in this area to see what's truly happening. And that's really where I'm going with this. Yes, this thing fires. Yes, we should pay attention to it. Yes, when I start showing you other examples of it, you're going to be like, man, I wish I knew then, especially recently, because you would have seen something and been like, man, I wish I knew then. So what is this firing off for us, or how would we use this? Well, one, I wouldn't say, well, we're going to use it as an omen. I think we should use it as there is a list of criteria that are showing extensive deterioration of the underlying market structure. And therefore, maybe we should pay more attention to it. Now, if we take a look at the SPX and when it fired in here, this is actually over a little bit more on the 19th. It actually broke out of the market and we ran. So that's not really an area where we would want to have gotten out of. Actually, what I even find so interesting about this area, and you'll note this when they fire, sometimes those areas become support, which is kind of interesting. But this tells us, if we looked at 24, what happened? Well, this is not something that we really would have acted on. And I don't know many people that are going to say, no, I'm just going to sit out of the market for a month because someday this might fire, right? We don't know that. And again, what happened here? We all know that this is July 17th. What happened? This is when we had a negative CPI and the market imploded. And then on top of that suck salad, we had Japan and what they were doing. And when they rebalanced their portfolio because they wanted to raise rates and then it threw up the Japanese yen trade, well, that's what you're dealing with here. Now, did this predict negative CPI? Did this predict the Japanese yen trade? Maybe these people knew it was coming. They're like, hey, we have to get out of the way. This whole thing's going to unwind. It's very possible, right? Because you're measuring human behavior, maybe. But I do think that it's important to understand why we dropped here. Now let's get back to it. Here's the Hindenburg Omen. And here we are firing in October, November. This is really November and December 2021. And what I would say about this, and what I think is important about this, is what I said earlier, where they want us to ignore. They really want us to ignore when it fires again. I don't think that you should. In other words, I think that if you're in a scenario where you've gone from positive to negative and negative to positive, negative to positive, positive to negative, you have a battle going on. And when you have those battles going on, you want to be aware of it. But I do think that there's other criteria that we could use along with this that tells us, is the deterioration in market structure getting better or worse? And I think that's how you have to view this. So in other words, okay, boom, this thing fired. Do I sell? No, there were other criteria that would have told you to get out of the market a while ago. And if you've been watching this channel, we talked about it a couple of weeks ago, like, hey, this is happening. This is getting really bad. You might want to get out of the way. And we've talked about that. We'll review it in a second here. So, we went to cash in the community, about 2.5, 3 weeks ago, because we saw it coming. And it also has allowed us to have better trades, like just be more short term and take advantage of the swings that we're seeing right now. And there is uncertainty, but I think we'll talk about that in a bit. But what I want to get to here is this, I got to get out of the market. Well, if you got out of the market here and then you popped up like this, you're going to have a problem. And the problem that you're going to have is that you're going to think that you're wrong. So you're going to need something that's telling you in here that you're not wrong and and how you're assessing the situation. And then how you could figure out what to do with it if you are wrong, right? Because you don't know that you're going to roll over here. At this point in time, all you have is this, right? So you literally have that part of the market. Just imagine that from here over, we don't know what we're going to have in here. And this is what you see on a chart. And if that's all you saw, well, that's going to be an issue. Let me see if I can make this even brighter for a sec so you can see where I'm going with this. It's not really going to help, but this is what you got. So you're going to have to just deal with me because we're just going to keep rocking and rolling. All right, so if you're looking at a chart and that's what you had, right? And you're like, I'm breaking out. Well, you're not going to be like, well, the Hindenburg Omen told me that we're going to roll over. So I'm just going to stay short. Like that's how you wind up in the basement eating Hot Pockets. So no, you don't do that. You have to trade what's in front of you. And at the time, that's what would have been. So you're going to want something else that shows you that that's deteriorating. I hope that makes sense. Go through a couple more of these so that you can see. So here we are in beginning of December, Jan 11, and the Hindenburg Omen fires, and we should get out of the market. And remember, this is no different than what I just showed you. And by example, if no different than 22, right? That what we just went over, 21 and 22. So if this fires and then you look at the market and you're like, I'm going to stay short because of the Hindenburg Omen. And just imagine that you don't know, this part of the chart for a second. You don't know what's going to happen over here. Are you going to stay short that? No. So the idea that you're going to say that you would have stayed short that 10 years ago, right? Or 10 years in the future, rather, during 21, end of 21, 22, it's just not realistic. You wouldn't have. You would have been like, market's breaking out. Maybe I should get involved. Maybe this Hindenburg Omen's not something. So you always want to be careful with this stuff to not have a confirmation bias. Like, don't say, I would have just stayed there because of the Hindenburg Omen. It's just not accurate. Now, here's April and March 2002. And you can see right there, it fired single fire and it was perfect. Like it was literally perfect. It's everything that you would have wanted in an indicator. You would have been like, you know what? We're trying to hit those highs. We're really struggling in here. We have the higher high in here. And you would have looked at this and said to yourself, okay, yeah, I'm going to watch this. And maybe we would have used other indicators to determine that deterioration. And I think that's really important. And then here always comes the big one that everybody wants to talk about. Well, in 1987, if I had done this, then I would have gotten out of the market crash. Well, sure, that's very true. And if you did it in 2002, you would have gotten out of the market crash. And if you did it in December 2010, you would have missed an entire run on the market. And again, I think that's really important because that's not realistic. So what we have to do is understand that when it fires, we go and look for other things. What I'm going to do is give you a snapshot of how you can kind of get ahead of these things. And you don't always know that you're going to get ahead of these things, but let's walk through it. So this is what we did in the community. And this is October 7th, I'm sorry. And we had a bunch of swings on. And what we did in here, I went through all the ones that I was close to break even or flat. I got out of them. And then there were ones that started to roll over, like Micron. We were up pretty much we're up a lot in it. So we just took the profit there. And some of these others, we just started getting out of the way. And then what we did was we just went after what the highest beta name was. And the highest beta name at the time with the most volatility was Tesla. And so we shorted Tesla. But you could see actually here, if you look, how the day progressed. So we start seeing it deteriorate, and then we start getting out, and then we start actually putting on a net short position. But we don't get out everything. So you get out, and then you watch what happens, and then you'll see what actually happened to us was by the 13th, we had some other trades on that we didn't move on. And then when we got out of it, we started to see more deterioration. So on the 13th, we're getting out of BE. We're getting out as it's trading up. We're getting out of more, move the rest to break even. We're getting out of the RKLB, and you can see the prices here on where we're getting out of these things at. And this is really important to get because you're not saying, okay, this is definitely, we're going to crash. You're allowing the market to tell you what it's going to do, and you're trading what's in front of you. It's very different. You're saying that this is something of significance, and we're starting to see that deterioration affect the market. Let's act on it. And I want to point out that distinction because it's very important to get. And so is explaining what you do when you see something. So I'm going to just take all this off for a second, and we'll clean everything off and start over in a moment here. But if you look at those timestamps, you'll see that we're getting out in here on the 7th. And then we have the big drop on Friday, and then we're not acting on that big drop. You don't want to be reactive. Retail's reactive. You don't want to trade like retail. Don't be retail. You want to be what the institutions are doing. The institutions are watching the deterioration happen in here, and they're getting out of the way before your big Hindenburg Omen even comes out and does anything. So once this hits and we start seeing this drop, this was already telegraphed in here. Drops down, starts to rally. You'll note that on these rallies into them, when we pop up, and we get in the middle of the bar, you'll note that that Monday we're getting out of more because the market's allowing us. See, it's not even a function of if you're going to break down, and this is super important to get. It's not even a function of if it's going to break down. It's a function of how are you going to act when you get to this level. Are you going to panic sell and then it goes against you? So you always want to be in a position of power. You always want to be in control when you're trading. And the reason I'm bringing this up is a lot of people aren't getting that. When you're scaling out in here, you're in control. When you're selling in here, the market's in control, saying you better get out of the way because we could come down to here. You don't know where that market's going to go. And anyone that's telling you they do is just, they're not being honest. So you have that little inside bar, and then you're looking at this and going, all right, well, that's a coin flip. That's retest up here or retest down here. And what do you get? You get a retest down here the next day. So the people that didn't get out don't have the flexibility to buy or get involved in this area. You watch this rally up, the pullback, the rally, and then you can see we're up here. And everyone's just saying the same thing to themselves. Oh, I just should have held. Okay, but here's the bottom line with this once again. And this is the one part of the video I'm really trying to hammer home. That's what you come into on Friday. And you're just going to say, I'm just going to hold that. That's not realistic at all. That's a dream that you're super smart. You're going to figure that out. I mean, if you look at how this one, when we broke down here in December, what happened? You never got above it, really. You did for a little bit, but then you rolled over by February and you got smashed. So you always want to think about like what's the worst case scenario, and then how do I adjust for that? Because it's not even just a function of the market itself. It's a function of your drawdown and how you're going to be when you're down here. Are you going to be flush with capital, or are you going to be stuck saying, I'm just going to hold them because they're good companies, because now you're a mutual fund, right? So that's the difference here. And everyone trades differently. But the way that I always view the market is you want to be in control. And then if the market drops, you want to be able to take advantage of that. So by doing what we did in here, that gave us that flexibility. Now let's talk a little bit about that and how you can spot things like that. So if we go to look at the New York Stock Exchange, and this is the daily, and the one thing that really, really bothers me in here more than anything about this chart, and I'm going to leave these others in here. These should have popped in. Yep, they're all here. Good. So this is a chart. I call this like the four horsemen, and you'll see me use this from time to time. These are just four major indicators that I use, and we'll go through them in a second here. But really what I want to focus on or show you here, sorry for these little beeps. We're going to get rid of those, and I don't really have time to edit that out this morning. But what I want you to get is, here's the RSI at 75. Here's the RSI at 61. Right? That's a major move for hitting a higher high on the New York Stock Exchange. Like that's not where you want to be, right? That is the exact opposite of where you want to be. Now, if you drop into this on a 4-hour, and we look at this on a 4-hour, you're going to note something. You're going to note September 12th. You're going to note September 23rd, and you're going to note, you got it right in here, on what? Tuesday the 7th. So we're hitting a high here on the market. And when I showed you on those timestamps, there's a reason I showed you that. What am I doing? I'm getting out of the way. I'm selling into this, into people, because I don't know which names are going to rally, which names are not going to rally. That's for a relative strength test to determine. And we can do that in another video, because you'll find out where the true leaders are on any pullback. But what does actually happen here? Well, this deteriorates, and we deteriorate right into this. So let's tie it all together. You have this Hindenburg Omen. People are looking at the Hindenburg Omen, but there were signs of this before, and I used a 4-hour on this, that you were already having these negative divergences. Now, if you follow this channel on RSI, I'm pretty candid about, like, people are like, oh, RSI doesn't work. Okay, maybe spend more than a weekend on it. Maybe stop listening to that dude on Twitter, because it does work. It might not work if you're trading zero-dated options, right? Because it's going to be too fast for that market. So maybe it's not the tool in your toolbox for the job. Just like if you are building a house, an electrician is not going to use drywall tools, right? A plumber, you don't want to run your electric, and you certainly don't want the plumber doing your framing. So there's different tools for different jobs, and you have to choose what's going to go in your toolbox for the job that you're going to do. Me as a pattern trader, a swing trader, and I obviously do a lot of day trading if you're in the community, but the more thematic stuff, if you're not really using RSI and you're utilizing 4-hour, hour, and daily charts, weekly charts, you're doing yourself a disservice. And the first reason that you're doing yourself a disservice is the one tool that all institutions use, and I mean all, is RSI. And there's a reason for it. RSI actually monitors positive directional movement and negative directional movement. It's actually the way that RSI is calculated. Like, that's exactly what this is: positive directional movement and negative directional movement. And then that calculation gives you an RSI number. There's a whole book on it by Wilder where he literally walks you through it. It's from the 70s. You can go look it up. If you guys are interested, drop a comment below on it, and I'll post the link to the book, and you can go get it. But it's very technical, but he walks you through how it's calculated. And I would strongly suggest, if you guys are interested in trying to get to that level, that you understand what you're really looking at, instead of just watching some like person on TikTok do a dance saying RSI doesn't work. All right. So then if we start drilling into this a little bit more, we could look at the MACD that from the Omen that they were talking about. And I'm just using a 4-hour now. But what are you seeing here on the 4-hour? Okay, well, the 4-hour is starting to roll over and it's starting to break. All right, I'm using the New York Stock Exchange because that's the biggest composite that we have, isn't it? And what are we saying here? So we're going to clean this off again, and let's get rid of that moving average for a sec, so that we're just really just looking at a clean chart here. And what are we saying? Well, we're seeing, and you could say, well, I don't like your RSI. I like MACD. I'm more of a MACD guy. Okay, well, here's the MACD doing something very similar. RSI's better. But I'm trying not to laugh, but it is. So then if you look at how this is rolling here and you go, geez, well, I don't know. Am I negative? Well, yeah, I am. I'm negative here. All right, but that's a 4-hour. It's not a daily. Let me go here and go, well, am I negative? Well, no, I'm not negative. All right, so do we have a true trigger? You could argue that you're negative versus the moving average line. And this is where it always gets so subjective with this data. Like, when you say negative, are you negative versus the average? Is 0 where the breath turns negative, or is it negative before then? See, like, if I'm going to sell predicated upon this, I would use MACD, and I'm not waiting for the 0 line. Like, thanks, dude. Like, I already knew I had a problem in here, right? You could already see it a problem when you broke here, that, hey, this might be an issue, a problem or a blessing. That's a problem. So, we could see that, and that could definitely be a problem for us. Therefore, we act on that problem, right? Okay. We might put our antenna up a little bit. Doesn't mean you have to get out of the market. And so what we're seeing here is clear deterioration. What bothers me, and let's tie it all together to now, is that this deterioration is getting more pronounced. The deterioration is getting more pronounced on the New York Stock Exchange. And you can see that, can't you? In other words, if we were going to do like an if-then chart, if 162 MACD is 21.7 here on the New York Stock Exchange, and then 21.7 here is 60. Well, that doesn't make a lot of sense, right? To us, we would think that, right? That might be something that we might think and go, all right, well, let's understand that could be an issue. And we keep going through this. Now, in front of you, this is rate of change. And these 4 horsemen, I pointed them out before, but it's MACD, it's rate of change, it's slow stochastics, and it's RSI. I like them, and they're like the big ones to me, and they all actually chart something else. And we're not going to get all into it, but they all chart something else. And so I find great value in that. But if I look at the New York Stock Exchange, and which is what we're looking at right now, the composite index, and my RSI is breaking the 0 line. You're not going higher, and it's not really rocket science as to why. And I'm going to explain it. This determines the rate of change of all the stocks that are in there based upon the previous day. If all the stocks that are in here are dropping and going negative, you can't go higher. Like it's not possible. You actually have to wait for it to turn to go higher. And I think that this is super important for people to get. Now, on this 9, which is what is standard for the Hindenburg Omen, they want you to use 50, and you'll see where I'm going with this. All right, so 50 has not broken. So do I have a correction here that's getting worse? Or do I have a situation where I have to wait for this to fire? Now, if I'm waiting for this to fire, you can see that it's fired in here a couple times. It's fired here. And let's look at where this 50 fires. Do I really want to wait for that? Probably not. Right? So understand that even when you're starting to look at how this stuff is calculated, is it possible that when this thing was created, that it was created before you had ETFs, algorithmic trading, high frequency trading? What was the average hold time of a stock when that was created versus what the average hold time of a stock is now? So is it possible that this thing's even outdated? It's possible. Does it mean that it doesn't have value? It does have value, in my opinion, and you should pay attention when it fires. Let me get to that right now. But that doesn't mean that I have to wait for a 50 indicator for that to happen. That doesn't mean that I have to wait for this to happen. If I see deterioration like this, you want to pay attention to it. And I'm going to show you why. You see the deterioration that you're seeing in this? And we're going to get rid of the rate of change, but understand rate of change is negative. But you see the deterioration and the speed in which this is dropping. And this is what I really want to point out. Now, I have to show it this way because of the data, and I want to continue to use TradingView. So we can see the line right here, and what we'll do is we'll change the color of that line to white so that you can just see it, and you can see your drop here. Now, the very first thing you're going to note is that here you had another drop, and again, for the reasons that we can see it, we're just going to go in here and we're going to change that to, we'll make it that color so that you can see it right in here for a moment. And you can see in here as well, when we clone this one as well, and then we'll just drop it down, that you already have a divergence right here. Going into 1987, you can see that divergence right in here, right? Higher high, and then you make a lower high into it. Then we drop. What I would point out, and what I think is important about 87, if you're looking at that, is the difference in speed in which the RSI fell. The difference in speed in which the RSI fell. That's really important to me. The way that you fell there is super important. You see how fast you fell here? That's really important. And it's really important to get that this happened before the crash. This was showing you this before that crash. And I think that's super important to get. So the speed in which you're dropping here over that period of time is very important to me. Now I'll show you again. Here you are in 2021. And what you'll note here is that you made a higher high. And then when you made that higher high here, a lower high there. And then after you made a higher high here, what happened? You made a lower high. The important thing about this is these are not nuanced. These are in your face, you have a problem. And I think that that's very important to get, because when we go and take a look at something like this in the future and you see these, they're there and they don't always fire. So here's one. Right? And then you can see the drop, and what that drop did was just set you up for months of building before you broke out and then fail and then continue to push higher. What does this mean? If you were to look at this chart and just understand where I'm going with this, and we look at this one here and the drop and the speed of that versus the drop and the speed there, it's a problem. Now, I'm not going to get into the pandemic area, but that's a problem. So if we took this out and made it simpler and go, all right, well, show me this on the weekly, you're not going to see it as clean on the weekly, but you'll see it right here. And we haven't had that one develop into the weekly yet. But let's go back here for a second. We'll just do it this way and say, all right, well, here we are on the weekly here. And what do we have? Well, you're not going to see it as clearly. So I think the best thing for us to do is understand and realize that we have to monitor this on a daily basis. The other thing that I would tend to do is then do a comparative analysis and say, all right, well, we have this. What else did the Hindenburg Index want us to look at? And let me be really clear about this before we go any further, because I do want to cover some names out there and I do want to talk about some stocks in a second here. But what is this really telling us if we look at this? Like where are we going with this? This is really bad. This RSI dropping like this is not good. I've seen good before. It doesn't look like this. So this is something that is a concern of mine that we have to watch. Now, if we go and take a look at the RSI for a second, we're going to clean this off and just look at the RSI for a second, you can see that drop. That is not not a small drop at all. So from here, we're going to take that off and we're going to just look at rate of change for a second and get rid of the McClellan as well. And we're just going to leave the rate of change up and we're going to just look at a couple things and say, all right, well, we flipped and we're negative. And then what we're going to do is go through this period of time over here and just say, okay, did we have anything that was commensurate with that as well? Well, we broke in here and we went negative, we tried to get through it, and then we went negative again, and we kept trying to get through it, and we kept breaking, positive to negative. Okay, so that is something that we have to be cognizant of. That is definitely something of interest. And we could even go back further and go look at the 80s. And when we do that, we can see that break right in here where you did break there, and that is commensurate with what happened. And then you rallied up and you broke it again. So what should you be taking from all of this, in my opinion? And there's a couple of things I think you should really be taking from this. I think you should really be considering that this is not great, what's going on. And that's definitely the first thing that I would be taking from it. It's not ideal, and there's some other stuff that I want to go over. Now let's take a look at one more thing that I think is really important. And what we've done today so far is just really tear down what we're looking at. We've really looked at what they're viewing and then went from there. And I think that's important. So like when we're looking at something, understanding what it truly is. In front of you is the calculation for 52-week highs divided by 52-week lows. And with that is also the 52-week highs by themselves and the 52-week lows by themselves. And what you're going to see here is pretty clear. One of the criteria was we need 52-week highs and we need a lot of 52-week lows in order for this to really fire and for this, quote, Hindenburg index to tell us that it's something of consequence. Okay, great. But they didn't really give us numbers, right? And they really can't because it's more antiquated. It's been around for a while. So if we look at Friday and we look at October 10th of Friday, and that was one of those areas that we thought had significance. And you can see what happened here on the 6th and the 7th. But if we really drill into this, what we should really do before we go any further, and then we're going to tear this apart again. But MAHN, MALN, 52-week highs, 52-week lows. And you know what we're looking at now. And if we're going to study this, then we're going to look at the highs and divided by the lows. But blue is the highs, green are the lows. Well, if we really look at what just happened, they both hit highs. And they're both pretty darn high in regards to where they've been in the past. So when we go and really look at what happened here, do you have a scenario really for a very long period of time where you've hit this many new highs and this many new lows at the same time? And so I'll show you what I mean by this so that you can get it, and then you'll understand why I dropped this here. So we're tying it back to what one of the criteria was before. Show me another spot in 2025 where the new highs and the new lows registered around the same area. And you don't have one. That is something that with the Hindenburg Omen, that is a red flag to me. I don't view that as a yellow flag. It's a red flag because that extreme uncertainty where they're like, get me in, get me out. I don't have that in 2025. I have more, let's be real clear about what I do have. I have, sheer panic when we had all that winning and liberation, sure. But do I have that many new highs and new lows in the same day? I don't have anything like what just happened this week. Nothing. And that's obviously because of the earnings that we went through. And I think that's important before we go into the next part of this. And really, what are we trying to do here? We're trying to make informed decisions. And what I would take from this is, I don't know if there's a crash coming. I know there's signs here of real deterioration under the hood. And to just pretend that it's not happening, I wouldn't do that. And I would look for clearer signs earlier. Now, they're telling us, I'm going to lift this all the way up. They're telling us that there's a level here that we have to concern ourselves with, new highs divided by new lows. And my argument to this would be, all right, great. Here we are, new highs, new lows. Is this something that I really have to concern myself with? I don't know that this relationship is historically telling me anything different than it's told me in the past. So I don't know that that's what I would focus on. What got me when I looked at this was looking at it the way that I did it. And why am I saying it this way? Because I want you to understand that when you tear this stuff apart and you really look at it, you're going to get the truth. And that's exactly what you're getting here. You're getting at these levels. I'll leave it like this. You're getting at those levels, and let's turn this back into, or not the ratio, but just an actual number, where you've never been here. You've never been in this kind of scenario. And I really can't stress how important that is. So my antenna's up, and it's going to stay up for a period of time here. That doesn't mean that I'm not going to trade. Let's be real clear about that. And I do want to go through some names that I think are super important because Friday was super active and I didn't have the time to really cover things, but there's some things here that we really do need to cover. And do I view them as red flags? No, but I do think there's some yellow flashing signs here that we should pay attention to. Now, the number one issue with Meta on this call, and for time's sake, we're going to talk about it versus just showing you the visuals. The number one issue was the revenue growth and the fact that CapEx is exceeding what the revenues are growing. On the call, Zuckerberg stated the following. He said, I have an issue here where people don't understand the overcapacity is necessary because the revenue will come and they need it. Well, if you need it, then you're not cutting your revenue projections for next quarter. So what you have here, and there's a great book on this called The Alchemy of Finance. It's by Soros. I really don't care about his politics, so you don't have to drop a comment in on it. For me, what's important about this is he walks through that first crack. And the first crack here is you have declining revenue. So you're pouring money into this. Then let's understand what Meta did this quarter. Let's take a second and just type it out so that we get it. All right, so they lowered revenue, right? They increased spending, right? And then after they lowered revenue, increased their CapEx spending, they also issued bonds of, I think it was 35 billion that was oversubscribed, right? And they were oversubscribed. We're going to use OS to describe that, up to 150 billion. That's how much the market wanted. Now, this is going to tell you a couple things. Number one, it's actually stated that if they continue to do what they're doing, Meta is going to be negative free cash flow in 6 months. So that's not going to happen without CalPERS and everybody else blowing out of their stocks. So they're not going to do that. So I'll tell you where I think you are with this. I think you're about 6 months away from them cutting CapEx or slowing CapEx and saying we have what we have now and we're going to leave it where it is. I think that that's where this is going unless they have a revenue or earnings breakthrough. But they're already telling you that they're not going to have that because they lowered guidance. Now, are they playing possum so that they could, do the market, buy their stock cheaper? You never know. And would a company do that? Yeah, they would. They've done it in the past. But the increase of CapEx spending here is what's so fascinating. The issuing of bonds versus cash is giving people those signals of 1999. I want to be very clear about this as I'm saying all this. I don't know what's going to happen. I don't see a lot of similarities yet between those two on valuations, between 99 and I traded during that, to what you see now. I don't see it yet. Cisco is trading 80 times earnings. We're nowhere near those levels on the Mag 7, like not even close. And they were paying for this all with secondaries and bond offerings. But the bond offerings like this with Meta, and what's happening here is I'm not the only guy that's still been trading since then. So when Oracle came out and they started we're going to do a bond issuance too. Well, that's why this looks like an absolute suck salad. It broke its put wall and is breaking here because people are looking at this and saying, what are the companies that can't keep up with their spending habits? That's what's scaring people here. They're literally looking at this saying, what are the companies that can't keep up with their spending habits? Well, Oracle's always been levered. He's always been a levered guy. Always. And a lot of people don't know that because he's way more quiet than the majority of these people. But he's always been a pretty levered guy in his own life and everything. So I understand why he's doing it, but is that money really there? Like, how are you going to pay this? What's that look like in 5 to 10 years? There's a lot to this. Microsoft, when they came out with earnings, and we're going to cover these because I think it's super important to get this, you've had nothing but selling and in the same level you were at before. Now, the problem with Microsoft is they've hitched their wagon to OpenAI. And if you really went through, and again, I'm going to talk about this versus showing it because I'm trying to pack it all in for you so that you have literally just this one video to watch. OpenAI was 7 cents. So literally 7 cents was what they made. So I know there's this video out of the CEO and Sam talking and they love one another on TV and everything else. But this is pretty damning. Like, don't get me wrong. The $1 billion investment in OpenAI is great. The hundreds of billions of dollars that Microsoft's going to give to OpenAI to make it go. And, now OpenAI wants to be the first $1 trillion IPO. That to me has all the makings of our Coinbase moment. And for people that don't know what I'm talking about, Coinbase, people are like, all you had to do was hold. All right, boomer, let me know how that goes. So when Coinbase went in April, that was pretty much it. And then Coinbase went from 423 all the way down to 34. And then everyone's like, oh, it's dead. And then guess where it is again, all the way back up. So where am I going with this? Well, with Microsoft, I actually thought Microsoft was decent. But the problem with Microsoft that they're running into is that they've hitched their wagon to OpenAI, and OpenAI does not seem to be the one that's gaining the market share and the traction right now. So that ties us to where, the bad to the okay. And I think Microsoft was okay. And let me go back and state this because this is an important part for you to know. Microsoft's Azure numbers, and I don't care how you pronounce it, I pronounce it the right way, was 37%. That was better than expected at 35%. So they are crushing it, right? They are absolutely unequivocally crushing it. But they're hitching the wagon to OpenAI, and I think that that might be more of an issue. If you talk to people right now that do use these large language models, you will find that the majority of people are trying different ones now. And that's definitely something that they're going to have a real problem with, because I don't know what the moat is for this. I haven't seen the moat. In other words, for me to switch from OpenAI to go use Anthropic or Claude is like, it's a keystroke. It's nothing. So I don't really see the moat where they have me embedded. And I think that that's really where Anthropic and Amazon actually made a huge difference here, because Amazon embedded Anthropic into AWS. And I think that's sickly brilliant. And that's why they absolutely crushed. But you hit all-time highs. You rejected on Friday. I thought this was an absolute blowout, but you're going to want to watch how this plays out. To me, this was like, oh, okay, this makes sense. If I had to look at it and say, okay, who are the big dogs and who really benefited? It was Amazon and Google, hands down. It wasn't even close when you go and take a look. I think Amazon and Google were really the leaders that came out of this. And this is how this always plays out. You get your leaders and you get the ones that are absolute disasters and the ones that fall by the wayside. And that's exactly what the market's telling you. Google didn't come out and say, we're going to have to issue $50 billion worth of bonds. Google didn't say that we're going to have to lower our revenue projections. Google took up their revenue projections. Google came out and said, by the way, we have a $155 billion backlog right now, right? And so what we've been saying here, if you've been watching these videos, is that they've probably been sandbagging as they're dealing with the FTC and everybody else. So they're like, what monopoly? What are you talking about, guys? And now we're starting to see that come out. And AWS was saying the same exact thing. I'm starting to see that there's certain names that are pull away. Now, if you start looking at something like an Apple had an amazing quarter, but you've gone from 200 to 270 in a very short period of time. And I think that you have to tie all this together. So do I see these cracks? Yeah, I do see these cracks. And I just want to give you a sense of where I'm going with this. I don't know that you're setting up for this huge crash. I do know that you're really weak in here. And I do know that trading has been optimal. Like, that's really how we absolutely killed it this week. And this is what I'm referring to. So ALAB will come out with earnings this week, and the trading is working way better. You don't have a strong foundation when the market is like 5 FI. When the market is like this and the 50-day is below, and you are below 50. Now, I pointed this out, how the market's going higher. We did this on Wednesday's video. And I'm trying to pack it all in because I wasn't able to do a video on Thursday because I was still trading by the time all night. It was crazy night. Anyway, so here you are, 55 and 40. Okay, great. So you're breaking there, meaning the foundation of the underlying market is getting worse. Here's the 50-day. You're trying to hold in here, and you held for the first time on Friday, which is actually good. But when you see something like an ALAB, what's happening to the market is this. You're trading up, and we had a great trade in this, ALAB, and you can see how that's rallying here. And then what happens? 201 to 88. These are not small moves, guys. These are not small moves in the middle of the day. So the idea that you're going to swing trade when the foundation of the entire market is as weak as we just presented, it's probably not ideal. And that's what you're seeing with some of these names where SanDisk is opening, oh, we're going to 210. No, we're at 188. Like, not a lot of people are holding those kinds of names. And you're seeing it everywhere, right? So it's important to understand where your levels are. But something even like a SanDisk, oh, we're at 280. This is going to be great. Or I'm sorry, Seagate. Oh, this is great. We're at 280. I don't know too many people that are putting these in. And what do I mean by putting these in? I don't know too many people that are putting in 15% stop losses. Like, that's probably not a great way to trade. So the foundation of the market's weak. The volatility's weak. This is presenting a great opportunity for short-term buyers. If you believe in this stuff, as I still do, the Seagates of the world, the SanDisks of the world, because everyone increased CapEx are left at where it is. And so that takes you into where we were before, right? It takes you into all this stuff that we've gone over for months, where we went and we reviewed this and said, here's your gold miners. They're the hyperscalers. They're the people that are actually doing the mining. Here's the tools that you're going to use to mine. Here's the data centers, right? And then here's the power to need it, which is the uranium. And then these are your banks, right? Your memory and your storage. So your banks would be this, your storage, and the memory would be the bank teller that goes and uses it, right? This was the equation that I gave like a month or two ago, and I just leave it up there. So when you look at this stuff, no, I don't think it's going away. But I do think that you've gotten to a point where you have to look at the underlying market and think that there is some kind of concern. I will leave you with this, because if we had real issues, if we had real issues in the market, like real issues, the bond market would not be accepting Meta's bonds. They wouldn't be oversubscribed. You'd be seeing massive buying of move, massive, and meaning bond volatility or bond protection. You don't hit all-time lows in bonds and usually trigger a crash, but that doesn't mean that you can't have a correction in the market. And the other side that I see out there is I see all these companies such as GSAT breaking out, and you might say like, well, what does that have to do anything? Well, you don't see people trying to do deals and M&A deals during environments like this. It just doesn't happen. If we were really going into something where people were really worried, they wouldn't be going out there and buying GSAT. They wouldn't be going out there and trying to figure out how they're going to buy Warner Brothers right now. They'd be rallying the wagons around their cash and waiting for the market to come in. So it's very clear that the higher level people don't think that you're going to go through some kind of, major drop. What we really want to do on the markets is we really want to watch what we talked about today, and we really want to watch what happens Monday in particular. Now, from my standpoint, like I broke out here. I don't like this at all. I'm just going to say it. I don't like this. I don't like any of this. But like if you see how we are up here and you gapped up, that is a true island. So if we gap down and close down, you would have an island reversal. So what we want to do is watch the positioning on Monday and see how that positioning has changed. And then maybe if we do get that pullback, we can look for the reset and go from there. I'd be more concerned if it was like Google's cutting CapEx and they missed. Microsoft's cutting CapEx and they missed. Amazon's cutting CapEx and they missed. That's not what's happening. What you're actually getting is, to find out, what is the real cream here. And I think that's an important distinction. That's it.